You're buying a home and money and figures are coming at you left, right, and center. Didn't mean money, but anyhow, the figures are coming at you left, right, and center. And you're just trying to keep your head up straight and hope that everything works out, you don't lose any money, and everything lines up. So what I'm going to do is go through how it works when you're getting different forms of help toward your closing costs, toward your purchase. And once I'm going to cover in this video are how they apply toward a conventional conforming loan, which also refers to Fannie Mae and Freddie Mac. They're conventional loans, and then the word conforming in there means conforms to Fannie Mae and Freddie Mac guidelines. Jumbo loans are also conventional loans, but they're conventional non-conforming because they do not conform to Fannie Mae, Freddie Mac guidelines. So just using the word conventional could apply to all of them, though in the general parlance, when people say conventional, they are usually referring to Fannie Mae and Freddie Mac. What this has, when you're getting help toward this, is they have what you call IPC limits. And IPC stands for Interested Party Contribution. When you were talking with your lender, if you were getting a lender credits are not subject to the IPC limit. So you don't have to worry if lender credit exceeds the IPC limit or if in combination of other things it exceeds it, because it does not come into play on whether or not you are going above the interested party contribution limit. Additionally, any mention of rate or cost in here are strictly for education purposes only. It's not an advertisement of rate or closing costs. It's just used to help explain how the numbers work. And one definition to watch for is what you call an overlay. Overlays in the mortgage world are rules that a lender sets that are above the published guidelines. What that means is, in these examples, Fannie Mae and Freddie Mac will allow something, but many lenders say, well, we don't want to allow that. And so they'll say, no, that's an overlay. The items I am going through, obviously we allow. And whatever lender you're working with, if you find yourself in a situation that I'll go through in the rest of this video, you'll want to discuss it with them ahead of time, make sure that they will allow it. Otherwise, you could get toward the end, find yourself defaulting hundreds, thousands of dollars, leaving it on the table, as it were. So what I'll start over here is go through the IPC limits, interested party contribution limits. When you're doing a down payment of less than 10%, that limit is 3% of the purchase price. If you're going 10% down up to just shy of 25% down, it's 6% limitation. 25% or more, the limitation is 9%. And these three apply to primary residences and vacation homes. If you're buying an investment property, the limitation is 2% across all down payments. Now let's move on to the figures. So let's say in this scenario, your home purchase is $500,000 and you've decided you want to put down 20%. You want to do this to avoid your mortgage insurance. So your down payment is $100,000. That's 20%. Now this figure, I'll circle back to it after we do the closing costs, but right now it is zero. And your loan amount is $400,000. So far, because we haven't gotten that far into this closing cost, you have no financing concessions and no sales concessions. Financing concession is funds that are allowed toward paying down or off your closing cost. A sales concession is something outside of that bucket. Now in this particular case, and I'm just using the example 3.75% on a 30-year fixed rate loan or a 30-year loan. On your $400,000 loan amount, the payment is $1,174.96. What we're going to start with is, let's say your closing costs are $12,000. Well, if you've got no help coming from anywhere, that means your funds due at closing are $112. That's $100,000 on your down payment. $12,000 closing cost, total is $112,000. Now let's say you're starting to get some help. So first of all, Your down payment's 20%, and it falls in that 10 to 25% bracket. So we know your IPC limit is 6%. That's $30,000. Now you're coming into this thing, and let's say you're working with an agent that gives a commission rebate to you of, let's call it 1%, $5,000. Now you got $5,000 toward that closing costs. So you have a financing concession of $5,000. That reduced the $12,000 that you owe there. Funds due to closing now are only $107,000. Now let's say while writing the offer, you weren't thinking about the commission rebate that you were getting, and you've worked out that the seller, you've asked them to pay $10,000. Now you've got seller help at $10,000. You've got $15,000 in help. So you're getting a little further along and toward closing, you realize this, but you've only got $12,000 in closing costs. So what happens next is finance concession. That's the $12,000. It takes care of all your closing costs. The extra $3,000 you got there is now a sales concession. And how does that work? That comes into play up here. So what we did is your sales concession is used to increase the down payment. So your 20% down payment actually dropped to $99,400. You've got the $3,000 extra that was in your help there. And now your new loan amount instead of $400,000 is $397,600. What you have now is a lower loan amount and, of course, a lower monthly payment, dropped to $1,167 from $1,174. And now your funds due at closing are strictly the 20% down payment, which after the sales concession calculation actually came to $99,400. You still don't need mortgage insurance. It's a straight up 20% down loan, and you owe less money. And it can keep going. Let's say when you locked in your rate, instead of points, you went the other way and you wanted a lender credit. Say you picked that rate and it happened to be giving you a $1,000 lender credit. $1,000 did a direct deduction off the closing costs. Your closing costs were $12 minus lender credit means your closing costs are now only $11,000. So the extra bit out of here, it bumped up the sales concession. So now your down payment is $99,200. The sales concession is used toward the increased down payment. You now have a loan amount of $396,800, and your payments drop to $1,165. When you get to closing, you only need $99,200. What I'm going to do next is move to a scenario lower loan amount and lower down payment, and we'll go through it again. So let's say now you're buying a home for $250,000. I'm going to notch these out for the time being. And let's say the closing costs in this scenario are $8,000. And you've decided you're going to do 5% down payment, $12,500. So as it starts, you come in here, you've got $8,000 in closing costs. You've got a down payment of $12,500. That's your 5% down payment. So you now have a loan amount of $237,500, and your 30-year principal and interest payment is $697, with $20,500 due at closing. So same thing now. As you wrote the offer, well, let's go over here. Skipped by. You know now, since you're doing 5% down, you have an IPC limit of 3%. So now, the maximum that can go toward closing costs is $7,500, and you've got $8,000 in closing costs. In this particular scenario, your real estate agent was giving you a real estate commission rebate of, let's say, $1,000. And then you wrote an offer the agent said, well, I think we're only allowed to have 3% toward closing costs, so let's ask for that. So they asked for $7,500. Now you've got total help of $8,500 because you guys weren't accounting for that. You have an IPC limit of $7,500. So even though your closing costs are $8,000, the financing concession, the amount that can apply toward closing costs, is only $7,500. That's the IPC limit. You've got this extra $1,000, so what do we do with it? That becomes a sales concession. As a sales concession, it's the same thing. It will be used, in effect, increasing your down payment. Your 5% down payment after the sales concession calculation is $12,450. You've got another $1,000 coming from your seller help / commission rebate. So now your loan amount is only $236,550. Payment's now $694.84, and now your funds due at closing is only $12,950. And this can continue. If you add points, it's not only going to help you here. You have to decide, oh, I got an extra $1,000, maybe I can add $1,000 in points. Because you still have financing concession of $7,500 and the $1,000 help here, you actually need more money. So you talk to your agent, and they finally lock you in, and there's just nothing at 0 points. The first thing has a little bit of a lender credit. Let's say it's $500. Now you've got a $500 lender credit. Closing costs were reduced to $7,500. That's not part of the ICP limit. You've got seller help covering that, but you've still got this $1,000 commission rebate. So what happens now? Still $250, $12,450 is your down payment. You got the extra $1,000 above and beyond the 3% IPC limit. Makes your loan amount $236,550. Your finance concession is actually covering all the closing costs in this particular case because the lender credit, as I mentioned, is not part of the IPC limit. And then you have the sales concession of $1,000. In this particular case, you need $12,450, which is just the down payment. So sometimes what happens when you start combining your lender credits with the seller help, IPC limits, and rebates, you can end up getting your closing costs mostly or completely covered and still keep your funds needed to a minimum, really just the down payment. If you have any questions or comments, please comment below, and I'll check and answer if anybody has any questions. I hope you find this very helpful, and thank you very much.